But we start today with the monster rally on Wall Street driven by a blowout jobs report. The surge in payrolls helping the Dow and the S&P post their biggest gains in more than a month. The S&P even erasing its sharp losses from earlier in the week. The focus now turns to next week's Fed meeting, the last of, get this, not just the year,
last of
the decade.
Come on.
Yep.
The decade.
End of an era.
And what a decade it has been,
of Fed. And I don't get Guy going on the decade that was the Fed.
Yeah, don't get me going.
This will turn into an ugly show.
Because we only have a half-hour show tonight. I'm happy. You happy?
I'm very happy. I'm always happy.
Hear the ring. First of all, welcome.
Thank you. Very, very good to be back.
It's Tyler, we've mentioned many times. I mean, that's CNBC royalty. It's here on a Friday, as Steve mentioned off air before. I mean, you drew the short straw, but you're here.
I am here.
So thank you.
And I am always delighted to be with you guys.
But to answer your question, I mean, listen, I
forgot the question.
The other three guys on the desk have absolutely been positive. They've been correct. This market seems impervious to all bad news. Today's job numbers, for those watching at home, people will say this was the best case scenario for both the market and the Fed next week. That all may be true. But you know what? As much as you can jawbone these trade talks, we're still no closer, I believe, today than we were 6 months ago or so. December 15th is right around the horizon. The warning signs are there. But then you look and see a market that's pushing all-time highs with stocks that, again, seem impervious to bad news. It's very hard to make a cogent negative argument right now.
It almost seems that bad news, I'm not going to say it's good news, but if bad news lingers, the Fed comes back in play.
Yeah.
So, and you can't risk shorting the market because you have a good headline coming out.
If there's a trade problem and there's no deal or tariffs go up, then it brings the Fed back into the game.
Then you have the Fed. So you have the Fed if bad news persists, economic data goes south. But if there's good news, the market rallies.
What's been so interesting to me this year, and maybe going back to maybe March of last year, is the idea that every day we come on air and we talk about the latest trade tweet or headline on.
It's been a week of that,
on
too.
Tuesday. Yeah, the president says, well, I don't need to do a deal. Maybe better off to wait until next year. So the market goes down. This morning, Larry Kudlow says, oh, we're getting close again. The market goes up in part for that, part for the jobs report. On any given day, the market is hostage to the trade headlines. But when you go back and you look at the whole year, there's been trade headlines practically every day, and the market's up, what, 25%?
Right. And Tyler,
so how material is it really?
It's interesting because, this week we've had a couple guests. I certainly remember Joe Lavorgna coming on here saying, trade deal means nothing to me. And ultimately, if you look at what's been priced in and how the market has responded, and there are a lot of folks that think that. I was listening to Adrian Mowat at CLSA, he's their strategist, saying the same thing today. And that ultimately, a trade deal is something that is seen as incremental delta from here higher, but that in the short run, we've priced in a trade deal. And if you think about today's payroll number, I've seen Goldilocks before, and Goldilocks looks pretty darn attractive today relative to I've seen Goldilocks. What it means is you got a boost. You almost got an acceleration of growth today from that payroll number. You had a jobless claims number yesterday that took away some of the fear. Total divergence between ADP and non-farm payrolls, which was bizarre. Treasury bond yields did almost nothing today. And also, when you looked at the wages, this was a non-inflationary payroll number. And I think that, I heard a lot of folks, a lot of economists I trust and think about come in today after this number and say, I still think the Fed's on hold until the middle part of 2020.
Yeah, I think you have to play that. I mean, even if they raised a quarter point, if you have strong payrolls like this, the market is going to say, hey, you know what? All that negativity that we priced in October and November is no longer warranted. So we have to reprice the acceleration. Whether or not that comes true, that's something for Q1, Q2 of next year. But for right now, I think was what Grasso's saying when you can't short this market is that the market just goes up on every single piece of these news. So to me, the way I've been playing it is you have this breakout in the market. Maybe it's a blow off top, but the bottom line is until proven otherwise, you have to be long stocks.
You're going to get your chance to short the market, I think, in come Q1. That's where you see where estimates are. And I think everyone's going to ratchet up estimates probably a little bit too high for earnings. If they can't walk over earnings, then you're going to get your chance to short them early next year, not now.
Not now. The thing that I look at, and I sit there and I go, okay, low inflation, moderate growth.
Low inflation, the way the Fed measures inflation.
The way the Fed measures inflation.
Okay, I'll play the game.
Okay, right. Pretty low inflation, moderate, not runaway growth, low and accommodating interest rates, recession and global slowdown, seemingly those worries are away. It doesn't get much better than that for stocks, right?
Doesn't get much better than that. And you add on top of that, in the fact that since September, the Fed has increased their balance sheet at the quickest pace they have in a decade. I mean, I think it's now more than $300 billion over that course of time. Now the balance sheet's north of $4 trillion again. I mean, that's a significant number, and the escalation. So
that's almost as much money as BlackRock has, right?
Which is equivalent to cutting.
Which is equivalent to
cutting. It's the reverse of the way it was when they were tightening.
But you have to ask yourself again, what do they see? You know, they call what they want. Doesn't matter what they call it. This is another round of QE. What do they see? What are they so scared of? I mean, that's what concerns me. Now, the market doesn't care. But you have to wonder what they care about.
Well, the market does care. The market cares that they're putting more liquidity into the system. That's all the market cares about at this point in time. I don't think they're seeing anything that anybody else is out there. I don't think they have a crystal ball. In fact, the history of the Fed shows that they're probably terrible at forecasting the economy. But the bottom line is, as long as they keep liquidity out there, and to Tyler's point, where we have an economic environment that is looking very different than it did 6 weeks ago. 6 weeks ago, there were calls for recession. 6 weeks ago, you saw global PMIs turning over. 6 weeks ago, you had bond markets saying, hey, things are going to be problems here. We saw the yield curve flattening again. All those things that the market priced in 6 weeks ago have changed over the last week.
And the most important thing, though, is you don't get a chance to, growing up in this business, basically, you got a chance to short the news. Buy the rumor, sell the news. Can you sell the news right now? You have 3 phases of it, or 5, or 6 phases of trade deal.
Okay, so to put a little sanity back into this, and we're not all insane.
Who's insane?
We're not insane.
Who's insane?
We're not insane. But in January 26th of 2018, it all seemed perfect too, and we saw a headline on trade. And so what we're maybe saying though is that we think trade has been put into an appropriate place here. But I think that ultimately you get to a place here where if we do see more deceleration, and to be clear, as good as this payroll number was, we've had a very choppy data front out of the U.S. over the last, call it 6 weeks. And that included an ISM this week that was weaker, and an ISM services that was weaker. So I think we have a case here, and we talked about the Fed. One of the more important parts about guys assessing that the Fed is not measuring inflation accurately is that we also heard some rumblings this week that the Fed's target is something they are willing to overshoot. And that's another one of these dynamics where we think we could let this thing run a lot hotter than we have in the past. Because let's face it, if anything, we really are fighting deflation.
But where are you bringing
that is the big goal.
Where are you bringing the sanity back in? Because the reason why the market's sold
I'm sorry. I accuse you of being insane.
Yeah, you finished off with joining a whole band of insane people over here.
I know. That's how
there is, at some point, you do have to exercise some caution because it wasn't even 3 days ago when we had the tweet or we had the news that perhaps the trade deal wasn't as good as possible. That will happen again. So how do you trade your portfolio in this, right? As the market starts to rise and as everybody gets euphoric, then you buy puts. You buy some protection. When the VIX is low, you want to buy some protection at that point in time. That way you can hold your core positions and you don't have to worry about the one tweet taking you out of a position.
We're 3 weeks away from the end of the decade.
Come on.
3 weeks away.
we don't talk enough about that.
Yeah.
I'm going to be back with you guys on Tuesday, but I'm going to ask the question tonight anyway. Will the next decade be as good as this decade has been for stock?
A lot of people believe that. A lot of people believe this is an autopilot. I'm hard-pressed to believe that's the case. I mean, I think, listen, I'm one of those people that believe that the errors and the mistakes of 08, 09 have not been solved. They've just been moved. And at a certain point, that has to come home to roost. And it's going to come home to roost at some point. And a decade is a long time. 10 years, if I'm not mistaken.
10 years.
So I'm hard-pressed to believe that next decade can be.
I'll be right here in 10
I'll
years.
give you an emphatic no on that.
No, it will not be as good.
It will not be as good.
Why though? But you could have these blips. You could have volatility. We all think sooner or later something has to blow up. But historically, stocks rise 10%, taking out all of the noise, 10% on average.
Although the preceding decade was a lost decade.
Yeah,
so, I mean, if you think about where we were, I mean,
and
you
the 70s
you have
were
this
horrible.
cyclicality.
You can have these periods of time where the stocks don't do well.
It was just
And if you
closed
look
in
at-
the 70s.
We're up 190%.
Later, we
in the
can pull
decade.
up a chart of the last decade and see how much we're up on the
It's like a New Year's show.
Yeah.
I'm
Thinking
warming up. I'm thinking ahead.
Can I just say, I know we got to go to break. You must have been a ball in the 70s, yes?
Oh, yes. I mean, I was more fun than I appear to be.
That's impossible to believe.
You look very fun.